AI in Corporate Lending, Real Use Cases, Not Hype. Author Manus AI. Date: April 2026. Disclaimer: this audiobook is provided for informational and educational purposes only. It is not legal advice, regulatory advice, investment advice, product certification, or institution-specific operating guidance. Listeners should evaluate all artificial intelligence use cases within their own legal, compliance, technology, model risk, and governance frameworks before deployment. Introduction: artificial intelligence is now discussed in nearly every banking strategy meeting, technology roadmap, and vendor presentation. Yet, in corporate lending, the conversation often suffers from a split between two extremes. On one side are inflated claims that artificial intelligence will soon replace underwriters, credit officers, and operations teams with nearly autonomous decision engines. On the other side is excessive caution that treats artificial intelligence as little more than a marketing label with no meaningful practical value. Both views are incomplete. The more useful truth sits in the middle. Corporate lending is one of the parts of banking where artificial intelligence can create real value, but that value usually appears in specific, controlled, workflow-level applications rather than in dramatic end-to-end automation. KPMG notes that in commercial lending, 30% to 40% of lending resources time can be consumed by manual activities such as data entry, document review, and quality checks across fragmented systems. That fact alone explains why the topic matters. If such a large share of staff effort is spent preparing information, validating inputs, and chasing documentation, then well-governed AI has a natural role as an accelerator. At the same time, official and industry sources consistently warn against naive deployment. The U.S. Government Accountability Office identifies bias, data quality issues, privacy concerns, and cybersecurity threats as significant risks in financial services AI. The U.S. Treasury similarly emphasizes that emerging AI systems require stronger terminology, lifecycle controls, explainability, data governance, and compliance review, especially because financial institutions remain in early-stage adoption for many advanced use cases. McKinsey's research on generative AI in credit risk points in the same direction. The most credible current deployments are narrow, non-customer-facing solutions that solve clear operational pain points and still rely on human review. This ebook, therefore, takes a deliberately practical position. It argues that the most valuable uses of AI in corporate lending are neither imaginary nor revolutionary in the cinematic sense. They are operational. They improve intake, analysis preparation, document review, covenant monitoring, servicing support, exception management, and portfolio surveillance. They help skilled professionals work faster, with better coverage and more consistent process discipline. But they do not remove the need for judgment, accountability, or governance. To make that case clearly, the discussion begins with the structure of corporate lending itself. It then explains what AI means in a lending context, identifies the strongest real-world use cases, distinguishes realistic benefits from hype, and ends with a governance and implementation roadmap that lending institutions can actually use. Chapter 1. Understanding Corporate Lending Before Understanding AI. A serious discussion about AI in corporate lending must begin with the business process, because artificial intelligence does not create value in the abstract. It creates value only when attached to a real task, a real handoff, or a real control point. Corporate lending is the business of extending credit to companies rather than retail consumers. Depending on the institution, the scope may include bilateral loans, syndicated loans, revolving credit facilities, term loans, acquisition finance, project finance, asset-based structures, and other commercial credit products. The lifecycle usually includes prospecting, origination, deal structuring, credit analysis, approval, documentation, booking, drawdowns, servicing, covenant monitoring, amendments, waivers, restructurings, and eventual repayment or exit. In practice, this is not a single workflow but an ecosystem of interconnected activities. Relationship managers gather client information and shape opportunities. Credit analysts assemble financial information and prepare analytical materials. Underwriters and credit officers review risk, structure, and policy fit. Legal and documentation teams coordinate contracts. Operations teams manage booking, notices, servicing, and exception queues. Portfolio and risk teams monitor performance after closing. Technology and support teams keep the platform stable. Each of these roles touches both structured data and unstructured information. That point matters because corporate lending is document-heavy by design. A single deal may involve financial statements, annual reports, compliance certificates, term sheets, credit applications, covenant packages, legal agreements, collateral information, emails, notices, amendments, waiver requests, and relationship notes. Much of the work is not pure decisioning. It is the preparation, checking, organizing, summarizing, and reconciling of information so that decision-makers can act with confidence. Here is a spoken summary of where AI may help across the lending lifecycle. In origination and intake, teams gather borrower materials, identify missing items, route requests, and check completeness. AI can classify documents, detect missing fields, summarize intake packages, and prioritize incomplete cases. In underwriting preparation, teams extract figures from financial statements, draft summaries, identify policy gaps, and build memo inputs. AI can support extraction, summarization, preliminary ratio preparation, and issue flagging. In documentation and closing, teams review document packs, check clauses, draft communications, and track conditions precedent. AI can assist with checklist validation, clause comparison, and communication drafting. In servicing and operations, teams process requests, handle notices, review exceptions, reconcile data, and manage workflow backlogs. AI can triage requests, suggest responses, surface anomalies, and improve queue prioritization. In portfolio monitoring, teams review covenants, monitor risk signals, summarize developments, and prioritize review coverage. AI can help identify early warning signals, track covenant packages, and summarize borrower developments. In restructuring and problem management, teams organize case history, summarize exposures, draft internal updates, and identify missing information. AI can assist with chronology building, document summarization, and issue tracking. When people claim that AI will simply transform lending, they often overlook this operational anatomy. The real opportunity is not a mystical intelligence layer floating above the business. It is the careful insertion of automation and machine assistance into the most time-consuming, error-prone, repetitive, and coverage-constrained activities across the lifecycle. Chapter 2. What AI actually means in a lending context. The phrase artificial intelligence can refer to very different technologies, and confusion begins when these differences are ignored. In lending, it is useful to distinguish among at least 4 categories. The first category is traditional analytics and rules-based automation. Many lending processes already use scoring rules, workflow routing, exception thresholds, and deterministic checks. These are often not AI in the fashionable sense, but they remain important building blocks for operational discipline. The second category is traditional machine learning. Treasury notes that AI has long been used in financial services, including credit underwriting, customer service, compliance, forecasting, and process automation. In this category, models typically learn patterns from training data and produce classifications, predictions, rankings, or probabilities. Examples in lending may include fraud detection, early warning models, prioritization engines, or pattern-based monitoring. The third category is document intelligence, often combining optical character recognition, natural language processing, computer vision, and workflow orchestration. This category is highly relevant in corporate lending because so much work begins with reading documents rather than only scoring records. Encino points specifically to underwriting support through natural language processing and computer vision for extracting and validating information from statements and related documents. The fourth category is generative AI, especially large language models. Treasury defines generative AI as a class of models capable of producing derived content such as text, audio, images, and other digital outputs. In corporate lending, generative AI is most useful when it synthesizes information, drafts summaries, structures narrative outputs, explains findings in natural language, and supports professionals in managing large volumes of unstructured content. Each category carries different benefits and different risks. Rules and workflow automation fit routing, checklists, threshold alerts, and deterministic validation. Their main strength is consistency and auditability, while their limitation is flexibility. Traditional machine learning fits fraud detection, prioritization, forecasting, and early warning indicators. Its main strength is pattern recognition at scale, while its main caution is model drift and explainability concerns. Document intelligence fits financial statement extraction, covenant package review, and completeness checks. Its main strength is speed in document-heavy workflows, while its main caution is extraction errors and source inconsistency. Generative AI fits memo drafting, summarization, communication support, and case synthesis. Its main strength is natural language productivity, while its main caution is hallucinations, unsupported conclusions, and overtrust. A professional operating model does not ask which of these categories is best in general. It asks which capability fits the actual task. In many lending environments, the most successful solutions will combine them. For example, a covenant monitoring workflow may use document extraction to read compliance packages, rules engines to compare values to thresholds, machine learning to prioritize cases, and generative AI to draft a concise internal summary for a portfolio manager. Chapter 3. Why the highest value use cases are usually not the flashiest ones. One of the central mistakes in AI strategy is to chase the most impressive-looking demonstration instead of the most economically meaningful workflow. Corporate lending rewards the opposite approach. The strongest use cases usually share 5 features. First, they target a large and recurring workload. Second, they reduce manual effort that is real but not strategically differentiated. Third, they operate on information that already exists inside a controlled process. Fourth, they produce outputs that can be reviewed by humans before becoming decisive. Fifth, they improve speed, consistency, coverage, or queue management without creating unacceptable explainability gaps. This is why the most valuable applications often involve preparation and support work rather than final approval decisions. McKinsey's findings are particularly useful here. Its survey of senior credit risk executives found that 20% had already implemented at least one generative AI use case and 60% expected to do so within a year. Yet the article emphasizes that current deployments are mostly narrow, non-customer-facing solutions focused on specific pain points. That pattern is not a sign of failure. It is a sign of maturity. Institutions are beginning where the risk-adjusted business case is strongest. A spoken summary of the difference between high-value reality and low-value hype may help. In credit memo support, reality means AI drafts sections, summarizes sources, cites evidence, and leaves judgment to analysts. Hype means AI writes a full memo with minimal review and is treated as inherently reliable. In financial spreading preparation, reality means AI extracts candidate values and flags ambiguities for analyst confirmation. Hype means AI is assumed to produce production-grade numbers with no reconciliation. In covenant monitoring, reality means AI tracks due packages, detects anomalies, and prioritizes review. Hype means AI replaces portfolio managers' interpretation of borrower risk. In client communication, reality means AI drafts internal or external messages subject to human approval. Hype means AI independently communicates sensitive credit positions without control. In early warning, reality means AI surfaces signals from data and news for human review. Hype means AI is treated as a self-sufficient risk authority. In underwriting, reality means AI accelerates preparation and issue detection. Hype means AI is assumed to make final, defensible credit decisions autonomously. In other words, the real opportunity is not to eliminate professionals. It is to let those professionals spend less time transcribing, collecting, chasing, and reformatting information, and more time interpreting risk, structuring transactions, and making accountable decisions. Chapter 4. Real use cases in origination and intake. The first meaningful area for AI in corporate lending is the front end of the process, where institutions gather information, assess completeness, and prepare a workable case file. Many institutions underestimate how much friction sits in intake. Borrower information may arrive in different formats, via multiple channels, with inconsistent labeling and varying quality. Documents may be incomplete, outdated, mismatched, or missing critical pages. Teams often spend considerable time simply figuring out what is present and what is absent. Here, AI can create value in a disciplined way. A document intelligence layer can classify incoming materials, identify likely document types, extract core metadata, and compare submissions to expected checklists. Generative AI can create concise intake summaries for internal users, highlighting what has been provided, what appears missing, and where follow-up may be needed. Workflow intelligence can prioritize files based on incompleteness, urgency, client segment, or transaction size. This type of support does not replace relationship management or credit analysis. It improves readiness. A cleaner intake package means a faster start to underwriting and fewer back-and-forth loops later in the process. In institutions pursuing greater client service quality, such tools can also improve transparency. Instead of vague statements that a package is under review, teams may be able to provide more precise internal tracking, clearer document requests, and more organized client follow-up. This is where AI begins to improve not only efficiency but also operating discipline. However, even this apparently simple use case requires controls. Document classification must be tested for accuracy. Extraction logic must be calibrated for varying templates and scanned quality. Human users must be trained not to assume that a machine-generated completeness status is always correct. The right operating model treats AI outputs as strong workflow assistants, not as unquestioned truth. Chapter 5. Real use cases in underwriting and credit memo preparation. Underwriting is the area that receives the most attention, but the most defensible AI use cases inside underwriting are often support functions rather than final decision engines. McKinsey describes several such uses in credit decision and underwriting processes. Generative AI tools can review documents, flag missing data or policy issues, compile information about customers, and draft portions of credit memos for human review. This is an excellent description of the real frontier. Underwriting teams often face information overload rather than information scarcity. The challenge is to assemble a coherent picture of the borrower quickly and accurately enough to support sound judgment. In corporate lending, underwriting support can take several forms. One is borrower information synthesis. AI can ingest annual reports, management presentations, financial statements, internal notes, and industry commentary, then produce a first-pass summary organized around business profile, leverage, liquidity, covenant headroom, sector risks, and open questions. Another is policy alignment support, where the system flags missing items or apparent exceptions relative to internal underwriting requirements. A third is memo drafting assistance, where AI prepares clearly labeled draft text for sections such as company overview, transaction summary, or recent performance narrative. A further use case is ratio preparation support. Agent-based workflows can extract values from source documents, calculate candidate ratios, compare them with expected thresholds, and summarize outputs for analysts. This can reduce repetitive preparation time, especially when analysts still validate the figures and resolve ambiguities. In a strong implementation, the machine does not replace analytical responsibility. It narrows the manual workload and makes review more focused. The most important caution is epistemic. Credit judgment is not merely a summarization problem. A borrower's risk profile may depend on context, exceptions, sponsor behavior, structure, concentration, and emerging developments that are not fully captured in documents alone. Generative AI can produce elegant prose that sounds authoritative even when the underlying interpretation is weak or incomplete. Treasury explicitly notes the risk of AI hallucinations, which can produce confidently stated but incorrect output. In underwriting, polished error is often more dangerous than obvious uncertainty. For that reason, institutions should view AI in underwriting as a decision preparation capability rather than a decision maker. The highest value design is one in which the system cites sources, exposes assumptions, flags unresolved issues, and makes analyst validation easier. If it instead obscures evidence behind fluent language, it weakens governance. Chapter 6. Real use cases in document intake, data extraction, and quality control. If one were forced to identify the single most practical area for AI in corporate lending, document handling would be a strong candidate. This is where the economics are most obvious and the human frustration most familiar. Lending workflows depend on extracting relevant information from heterogeneous, imperfect, and often repetitive document sets. Financial statements must be read. Covenant certificates must be checked. Legal documents must be compared. Supporting evidence must be linked to requested fields. In many institutions, these activities are still highly manual or only partially digitized. KPMG's observation that 30% to 40% of lending resources time is spent on data entry, quality checks, and document review is particularly important here. This figure reframes AI from a speculative initiative into a response to a measurable operational burden. Every hour spent rekeying data or manually confirming completeness is an hour not spent on structuring, judgment, negotiation, or portfolio insight. Encino similarly highlights underwriting support through natural language processing and computer vision, especially for extracting and validating information from income statements, bank statements, and tax returns. Although such examples often emerge from broader lending contexts, the underlying logic translates well to commercial and corporate settings. Extract candidate data, compare against expected structures, identify gaps, and route exceptions to qualified reviewers. The benefits of this approach are several. First, it can reduce cycle time. Second, it can improve consistency by applying the same validation logic across files. Third, it can strengthen control by making missing data and anomalies more visible. Fourth, it can create better audit trails if the system preserves source references and user review actions. Yet, the limitations are equally important. Source documents vary in quality. Financial statements may use different formats and definitions. Scanned files may contain poor image quality. Tables can be misread. Contextual distinctions may be lost. A prudent institution, therefore, avoids full automation of sensitive numeric ingestion unless source reliability and reconciliation controls are strong. The better approach is staged augmentation. Machine extraction first, human confirmation second, final posting third. A mature posture toward document intelligence use cases can be described simply. For document classification, AI identifies the likely type and tags the file, while humans confirm unclear cases. For data extraction, AI pulls candidate values and key fields, while humans validate and resolve ambiguities. For completeness checks, AI compares received items against a checklist, while humans approve completion status. For quality control, AI flags inconsistencies or missing signatures or pages, while humans investigate and decide. For narrative summary, AI drafts a concise document synopsis, while humans approve or edit it before use. Chapter 7. Real use cases in portfolio monitoring, covenant tracking, and early warning. Many discussions about AI in lending concentrate too heavily on origination. In practice, post-origination monitoring may be one of the most attractive areas for real value because the volume of ongoing review work is large, recurring, and difficult to scale manually. Moody's provides a particularly useful example. Its loan monitoring material describes AI-supported capabilities to identify and prioritize risky loans early, track, request, collect, and validate covenant documents, and surface early warning signals based on multiple performance indicators. This is exactly the type of use case that deserves more attention in corporate lending. Portfolio teams often face a classic coverage problem. They must monitor a large book of loans with limited time, incomplete data freshness, and varying levels of borrower complexity. Not every account can receive the same level of detailed review every day or every week. As a result, institutions benefit greatly from tools that prioritize where attention is needed. AI can help in three main ways. First, it can improve surveillance breadth by continuously scanning available data, news, and internal signals. Second, it can improve review prioritization by ranking cases that deserve immediate human attention. Third, it can improve communication quality by converting scattered information into concise summaries for portfolio managers, relationship teams, and risk committees. Covenant tracking is a particularly strong application. Missing or delayed covenant packages, exceptions, and manual follow-up loops create friction and control risk. AI can help identify due dates, detect absent materials, validate whether submitted documents appear to match requested items, and surface potential breaches or inconsistencies. The real value is not that AI understands credit better than a portfolio manager. The real value is that it helps ensure that signals are noticed earlier and that scarce expert attention is directed where it matters most. This is also a domain where explainability expectations are more manageable than in automated approval decisions. If an AI system says, in effect, these 20 names need earlier review because leverage moved, filings are delayed, and sector news deteriorated, the human can examine the rationale. The system functions as a surveillance assistant rather than a silent decision maker. Chapter 8. Real use cases in client service, relationship support, and lending operations. Corporate lending is not only about risk decisions. It is also about communication, coordination, and operational continuity. Relationship managers, operations teams, and servicing staff spend significant time answering questions, drafting follow-up notes, explaining status, responding to routine requests, and moving work across teams. McKinsey notes that in client engagement, generative AI can help relationship managers by drafting individualized outreach communications, summarizing meetings, and suggesting next steps. It also notes the potential for customer assistance use cases, including drafting personalized outreach and supporting restructuring-related interactions. These use cases are important precisely because they are not glamorous. They address real-time consumption in roles that must manage a high volume of interactions while maintaining professionalism and accuracy. In lending operations, AI can support queue triage, case summarization, and response drafting. For example, when a servicing request arrives, an AI assistant may summarize the request history, identify the likely transaction context, pull related notices, and propose a response draft for an operator to edit. In support environments, it may help classify incidents, surface probable root causes, or suggest knowledge-based content. The value here is cumulative. No single drafted email transforms a lending business. But across thousands of interactions, well-designed assistants can reduce response times, improve consistency, and lower routine cognitive load. This is especially relevant in operations environments where experienced staff are scarce and junior staff may need structured support. Still, institutions must be careful with external communications. Sensitive lending communications can have legal, reputational, or relational consequences. For that reason, external use cases usually require stricter controls than internal drafting tools. Human approval, approved language libraries, tone constraints, and escalation rules are all part of a credible operating model. Chapter 9. Fraud, Identity, and Anomaly Detection as Supporting Layers. Although corporate lending discussions often focus on underwriting and document management, AI can also play a supporting role in fraud and anomaly detection. Encino points to fraud detection through machine learning and anomaly detection techniques, while Treasury's broader financial services work highlights AI's relevance to fraud detection and operational resilience. In corporate lending, fraud-related use cases may involve identity anomalies, inconsistent documentation, suspicious transaction behavior, pattern deviations across related entities, or unusual changes in client-submitted information. These are rarely self-contained credit decisions. Rather, they are risk overlays that enrich the monitoring environment. A useful design principle is that fraud analytics should usually complement, not replace, existing controls. AI can help surface unusual patterns faster than manual review alone, but it should connect to investigation workflows, escalation processes, and documentation standards. This is especially important because false positives may burden teams and damage client experience if not managed carefully. Chapter 10. What AI cannot reliably do in corporate lending. A realistic ebook on AI in corporate lending must discuss limits as directly as benefits. Artificial intelligence is not a neutral force that automatically improves every process it touches. In some contexts, it introduces new failure modes faster than it removes old ones. The first limitation is hallucination and unsupported synthesis. Treasury explicitly notes that advanced generative systems can produce confidently stated but incorrect output. In lending, this may mean fabricated explanations, incorrect borrower interpretations, missing caveats, or unsupported conclusions embedded in persuasive narrative. When people rely on fluent output rather than on source-grounded review, risk rises quickly. The second limitation is weak explainability in high-stakes decisions. A lending institution must often defend its decisions internally, to auditors, to regulators, and sometimes to clients. If a model meaningfully influences a credit outcome, the institution must understand how and why. The GAO's analysis of AI in financial services highlights bias and data quality concerns, reinforcing the need for explainable and defensible use. In corporate lending, a system that cannot support transparent rationale is poorly suited to sole decision authority. The third limitation is data quality dependency. AI does not magically repair fragmented source systems, inconsistent data definitions, stale borrower information, or weak document governance. In fact, poor inputs often produce faster, more polished versions of poor outputs. A bank that has not addressed foundational data issues may find that AI simply accelerates confusion. The fourth limitation is context depth. Corporate lending decisions often depend on nuances that sit beyond the immediate dataset. Sponsor behavior, intercreditor structure, sector-specific cyclicality, management quality, legal nuances, workout history, informal relationship knowledge, or subtle changes in borrower strategy. Experienced lenders integrate these signals in ways that current AI tools often approximate only partially. The fifth limitation is accountability. Loans are not approved by language models. They are approved by institutions, committees, delegated authorities, and named professionals. No serious governance model should allow ambiguity about who owns the decision. These limitations do not mean AI lacks value. They mean that the most successful institutions will place AI where it is strongest: preparation, detection, summarization, prioritization, and assistance. Chapter 11. Governance, compliance, and human oversight. If real use cases form the opportunity side of the story, governance forms the credibility side. Without governance, AI in corporate lending becomes either a compliance problem or a pilot graveyard. Official sources are consistent on this point. The GAO warns of biased lending decisions, data quality problems, privacy concerns, and cybersecurity threats. Treasury argues that institutions need common terminology, strong risk management practices, lifecycle controls, and compliance review before and after deployment. Treasury also notes the importance of privacy, security, quality standards, and clearer supervisory expectations. A governance framework for corporate lending AI should cover at least the following dimensions. First, use case classification. Institutions must ask whether the system provides assistance, prioritization, recommendation, or decisioning, because control intensity should depend on impact level. Second, data governance. Institutions must know whether inputs are accurate, current, permissioned, and explainable, because poor borrower or portfolio data can distort outcomes. Third, model risk management. Institutions must define how the system is validated, monitored, and challenged, because models may drift or behave unpredictably in changing conditions. Fourth, explainability. Users must be able to understand why the output was produced, because lending requires defensibility and reviewability. Fifth, human oversight. Institutions must specify who reviews, approves, overrides, or escalates outputs, because accountability cannot be outsourced to software. Sixth, compliance and legal review. Institutions must confirm whether the use case aligns with existing laws, policies, and record-keeping requirements, because credit-related activities are highly regulated and scrutinized. Seventh, third-party risk. Institutions must understand vendor dependencies, data transfers, and concentration risks. Eighth, security and resilience. Institutions must define how the system is protected, logged, and recovered, because sensitive borrower information requires strong protection. A particularly important principle is the distinction between human in the loop, human on the loop, and human out of the loop operating models. In sensitive corporate lending use cases, the first model is often the safest and most defensible. AI produces a draft, a signal, or a recommendation, but a qualified human reviews the output before it becomes operationally decisive. The second model, where a human oversees a largely automated process, may be appropriate for lower-risk workflow steps. The third model, where no human review occurs, should be approached with extreme caution in lending contexts. Another important issue is third-party dependence. Treasury notes that many financial firms rely on third parties to develop and deploy advanced AI models. The GAO likewise points to oversight challenges involving technology service providers. In corporate lending, this means that vendor governance cannot be a side topic. Institutions need clarity on data handling, model behavior, security, retraining, incident management, audit access, and change control. The mature objective is therefore not to use AI faster. It is to use AI responsibly enough that scale becomes sustainable. Chapter 12. Workforce Implications and the Future of Lending Roles. AI adoption in corporate lending will change work, but it will not eliminate the need for domain expertise. Instead, it is likely to shift the composition of value within roles. Encino points out that human teams need new capabilities such as data literacy, analytical thinking, and the ability to collaborate effectively with AI systems. This observation is more important than it may first appear. In many lending environments, the workforce challenge is not simply technical adoption. It is the development of professionals who can review machine outputs critically, identify hidden assumptions, challenge weak conclusions, and integrate AI assistance into sound credit and operational judgment. Analysts may spend less time on repetitive extraction and more time on interpretation. Operations teams may spend less time routing routine work and more time resolving exceptions. Relationship teams may spend less time writing first-draft communications and more time on client strategy. Risk teams may move from sampling limited portfolios toward reviewing AI-prioritized cues with broader coverage. This shift has two implications. First, institutions should not assess AI purely as a cost-cutting exercise. The larger opportunity may be role redesign toward higher-value work. Second, training becomes essential. A workforce that either distrusts all AI outputs or overtrusts them entirely will struggle. The goal is disciplined adoption, where users understand both the power and the limitations of the tools available to them. Chapter 13. A Practical Implementation Roadmap. Many institutions fail not because the use cases are bad, but because the sequencing is poor. A bank that tries to leap directly into AI-driven credit decisions without building data foundations, governance, and narrow workflow wins is likely to create resistance and risk. A better path is phased. Phase 1 focuses on identifying high-friction manual workflows. Typical outputs include a prioritized use case inventory, a pain point assessment, and a control mapping. Phase 2 focuses on piloting low to medium risk assistance use cases such as document summarization, intake classification, covenant tracking support, and memo drafting pilots. Phase 3 focuses on building governance and operating controls such as validation standards, human review rules, audit logging, vendor controls, and approval workflows. Phase 4 focuses on integrating solutions into production workflows through workflow orchestration, knowledge integration, exception routing, and performance dashboards. Phase 5 focuses on expanding with evidence, using measured accuracy, time savings, control quality, and user adoption to guide the next wave of use cases. A sound implementation program begins with a simple question. Where do trained professionals spend time on work that is necessary but not uniquely human? That is often the best starting point. The next question is equally important. Can the output be reviewed before it becomes decisive? If the answer is yes, the use case is often more suitable for early adoption. If the answer is no, the governance burden rises significantly. Institutions should also measure success with more nuance than headcount reduction. Useful metrics may include cycle time improvement, reduction in rework, exception detection coverage, document completeness rates, user satisfaction, auditability, and model override patterns. In corporate lending, a faster process is not better if it produces weaker control. Chapter 14. The Future, From Helpful Tools to AI-Native Lending Operations. The future of AI in corporate lending is likely to be meaningful but gradual. Treasury's reporting suggests that financial institutions are expanding AI usage while still proceeding cautiously, especially in higher-risk contexts. McKinsey's evidence likewise suggests selective operational deployment rather than wholesale replacement. This pattern is likely to continue. In the near term, the most successful institutions will probably be those that build AI-enhanced operating layers around existing lending platforms and processes. These layers will summarize documents, prepare narratives, detect anomalies, prioritize attention, and support knowledge retrieval. Over time, those capabilities may become more deeply embedded into workflow engines, portfolio platforms, covenant monitoring tools, servicing systems, and analyst workbenches. What is less likely, at least in serious institutions, is the full delegation of corporate credit authority to opaque models. The economic, regulatory, and reputational stakes are too high, and the business too context-sensitive. The long-run transformation is therefore not the disappearance of lenders. It is the rise of a lending environment in which skilled professionals are supported by increasingly capable systems that reduce manual burden and improve insight density. That future will reward institutions that can combine three strengths at once: business understanding, technical execution, and governance maturity. An institution with only the first will remain manual. An institution with only the second may become fast but unstable. An institution with only the third may become cautious but stagnant. Competitive advantage will belong to those that can connect all three. Conclusion: the most important lesson about AI in corporate lending is that the real story is more practical than dramatic. The value is not primarily in replacing judgment, but in improving the quality, speed, consistency, and coverage of the workflows that surround judgment. Corporate lending is well suited to this kind of augmentation because it is rich in documents, deadlines, exceptions, follow-ups, and recurring review work. That is why AI can genuinely help with intake, extraction, underwriting preparation, monitoring, covenant tracking, servicing support, and communication drafting. KPMG's estimate about manual workload, McKinsey's evidence on narrow operational deployment, Moody's emphasis on monitoring, and Treasury's governance guidance all point toward the same conclusion. The strongest use cases are real, but they are controlled. The institutions that succeed will not be those that make the loudest claims. They will be the ones that map use cases carefully, select the right tasks, preserve human accountability, control model risk, govern vendors, and build the organizational capability to use AI as a disciplined operating tool. In that sense, the future of AI in corporate lending is neither hype nor fiction. It is work. And for serious institutions, that is good news. Appendix A. Glossary of key terms. Corporate lending means lending to companies, often involving structured facilities, covenants, legal documentation, and ongoing monitoring. Underwriting means the process of assessing borrower risk, structure, policy fit, and transaction terms before approval. Credit memo means the internal document used to present transaction details, analysis, recommendation, and risks for approval. Covenant means a contractual obligation or financial threshold the borrower must maintain or report against. Early warning signal means an indicator suggesting rising risk before a full deterioration event becomes obvious. Document intelligence means AI-enabled extraction, classification, and interpretation of information from documents. Generative AI means AI capable of creating new content such as text, summaries, drafts, or other outputs based on learned patterns. Human-in-the-loop means an operating model in which humans review and approve AI outputs before operational use. Model risk means the risk that a model is wrong, misused, misunderstood, or applied outside appropriate limits. Explainability means the ability to understand and communicate why a model or system produced an output. Appendix B. Practical AI Use Case Assessment Template. A useful way to evaluate any proposed AI use case in corporate lending is to ask 6 questions. First, what exact workflow pain point is being solved, and how much time or risk does it currently create? Second, what inputs will the system use, and are those inputs reliable enough for the proposed task? Third, what type of output will be produced? A summary, a flag, a recommendation, or a decision? Fourth, who will review the output and what happens when they disagree with it? Fifth, what are the main failure modes, including hallucinations, extraction errors, privacy concerns, bias, or weak explainability? Sixth, how will the institution measure whether the use case genuinely improves quality, speed, or control? The best use cases are usually those where the problem is clear, the data is reasonably available, the output can be reviewed, and the workflow benefit is significant even if the model is not perfect. References. Reference 1. KPMG, Accelerating Commercial Lending with Artificial Intelligence. Reference 2. U.S. Government Accountability Office Artificial Intelligence, Use and Oversight in Financial Services. Reference 3. U.S. Department of the Treasury Artificial Intelligence in Financial Services. Reference 4. U.S. Department of the Treasury releases 2 new resources to guide AI use in the financial sector. Reference 5. McKinsey Embracing Generative AI in Credit Risk. Reference 6. Encino, The Future of Lending with Artificial Intelligence. Reference 7. Moody's AI-Powered Loan Monitoring System.